I'm Ashton Addison from EventChain for Investmentpitch Media and FinTech News Network. And today on Blockchain Interviews, we have Meb Faber, the founder and chief investment officer at Cambria Investment Management and the host of the Meb Faber Show. Meb, welcome to the show and thanks for taking the time to be here.
My pleasure.
I'd love to kick off our interview by just starting with a little bit of your background in finance and what are your current focuses right now in this market?
We're based here in Los Angeles. We are a quant investment manager, so we have about 12 funds, manage almost $1 billion in assets, everything from stocks to bonds to asset allocation, all in between. I cut my teeth at university as an engineer, and then worked as a biotech analyst, and then as a quantitative analyst for a commodity trading advisor before founding Cambria in 2006, started managing money before the last financial crisis, before this one in 2007. So been at it for a little over a decade here. And yeah, if anybody finds themselves in Los Angeles, come say hello at a distance.
Very cool. And yeah, that's an interesting background. And yeah, a lot's happened since the financial crisis, and it seems like we're heading into a predicament in the market with the stimulus and the debt, and we can jump into that. But I want to talk about the equities market right now. It's a V-shaped recovery. It's doing well, moving into the election, which is always what the people that are getting elected want to see. But there's also caution because fundamental values aren't really the same as they were, and there's a lot more hype and other factors involved into what's making the market, what's pricing the market. Can you take a look, give your take on how do you see this market post-election? Are you approaching it cautiously, and should others do the same?
Oh boy, it's a lot. Okay, so first of all, if you want to start with stocks, I mean, U.S. stocks, where most people tend to be interested in, we tend to have a long-term perspective, which I think is pretty significantly important with markets. And so U.S. stocks, our opinion, it's no question they're expensive. The question is, does that matter? And so if you look back in history for U.S. stock valuations, you could take them back to the 1800s. On average, if you look at long-term PE ratios, around 17, low inflationary times around 22. Right now in the low 30s, that's high. It's not as high as it's ever been. In the late 90s, it's been as high as 45 in the U.S. Now it's been as low as 5 as well. And why does that matter? Well, it matters because in any sort of investments, whether it's cars, whether it's houses, whether it's a private business, valuation matters. And on aggregate, having a higher valuation just means it's going to be a headwind. And so most investors expect around 10% returns in U.S. stocks, which is roughly what they've done over the past 120 years. The problem with that is that you're starting with a low dividend yield, even if you assume historical growth, largely because we've come off a decade of amazing returns in the U.S. stock market. That valuation compression, which is most likely, if you go to Vegas and you're playing poker or blackjack, it's the same way to think about it, which is probabilities. The most likely scenario is valuations drift back down to normal, in which case you get about a 4% return in U.S. stocks. Again, not horrific, not terrible, but also not great. And the challenge is you see these survey after survey and ask people what they expect, and usually it's around 10%. And the most recent survey in the U.S. by Schroders had U.S. investors expecting 15% in U.S. stocks. So there's this big disconnect where people extrapolate the most recent past. In U.S. stocks in general, versus the rest of the world, having such significant outperformance is not normal. It happens, but you have to go back to the late 90s to have a decade where the U.S. stocks outperform the rest of the world as much as they have, and then before that, all the way to the 1920s. So it's always dangerous to extrapolate what's been going on in the most recent past. But again, not horrific, not a bubble, not like the worst thing we've ever seen, just not great.
It's an interesting take, and investment firms, they have to have that long-term approach, but because of the low interest rates and people looking to move capital around, a lot of retail investors have jumped into Robinhood and become investors, as they think, or swing traders, and they're sort of just jumping into whatever's hot. Do you see that as a dangerous move, and likely the majority of people end up losing money to a small amount of people? Do you see that playing out potentially?
On average, hyperactivity in general, and this doesn't just apply to individuals. This applies to the world's biggest institutions that manage hundreds of billions, if not trillions of dollars. They make the same mistakes. They may describe them in different terms, use more sophisticated committees and analysis, but they end up with the same behavioral human problems that we have as individuals, which is the time frame for these investments to play out. I guarantee you must ask most of your audience, it's in terms of months, quarters, years. But for most people, it's around 2 to 3 years how long they'll give an investment. And I used to tell investors the answer is they say, hey, Meb, how long should I wait for an investment or a manager or whatever to see if it worked out? And I used to say 10, and they would laugh. And now I actually say 20. And let me give you an example real quick. Almost everyone, the most universal held belief in all of investing is that stocks outperform bonds. I don't know anyone that doesn't believe that over time. The problem they run into is the over time concept, where you ask people how long they would give stocks to outperform bonds, and almost everyone is 3, 5 years, maybe 10. There was a period this year in 2020 in March where U.S. stocks had similar performance as bonds for 40 years, not 10, not 20, 40 years. And so
Wow.
This concept of, if you're going to be different, if you're going to allocate to something, the time horizon mismatch creates problems. And so back to your original question, a great example is what used to be popular is foreign exchange trading. And a lot of these foreign exchange brokerages, and these brokerages had to publish the percentage of traders that were profitable. And I think many of the numbers, it was something like 98% lost money. So it's hard on such microscopic time horizons. The best thing you can do as an individual is push that out into years and decades.
Definitely, definitely. And you mentioned bonds. A lot of people, they only focus on the stock market because it's much more exciting to be talking about Tesla than it is about bonds. But I think the bonds play an important role in the stock market and the economy as a whole. Do you have any insight into, should equity investors be looking at the bond market or other leading factors that may affect the equities market?
Yeah. So no matter what, over time, you want to own assets, particularly stocks and businesses. They could be public like stocks, private businesses. Bonds play a unique role. Cash plays a unique role in that it gives you some optionality. One of the biggest problems individuals always run into is they get over leveraged, they borrow money. So having that cash bond cushion is fine. No one complains usually as years go by when they go through a crisis, say, oh man, I had too much cash in 08, 09. I had too much cash in March of this year. Most people have the opposite problem, which is they use leverage and debt. Bonds also play a role in a deflationary environment. And you've seen this around the rest of the world, where not only is it just bond yields are low here, in most of the sovereigns around the world, bonds are actually zero or negative already. And so if you have a deflationary push, but the big takeaway is when you put together all these assets, whether it's stocks, whether it's bonds, whether it's real assets like commodities and real estate, you want to put together a portfolio that lets you sleep at night and you can own for long periods. We just did a recent article on the blog talking about the election that you referenced in the beginning and alluded to. And we said, this is how the Trump or Biden presidency will affect your investments. We did a similar article 4 years ago. The takeaway was that as long as you have some of the main ingredients, global stocks, global bonds, global real assets, it doesn't really matter what you have. But one of the biggest problems people have is they overpay for all of that. And one of the good things about 2020, and there hasn't been that many, is that you can essentially get that portfolio of global assets in 2020 for free, darn near close, with no transactions through commissions and also through a basket of ETFs. That are almost close to zero in charges. Amazing time to be an investor. But again, you want to own a portfolio of those assets and then just leave it alone.
Yeah, and that's great advice. And you mentioned, the upcoming election. I want to get your take on political risk. There's so many different types of risk in a portfolio, and 2020 is an interesting year. I was just discussing this on another interview, that there is political risk, but there's also other risks because the market coming up to the election seems to be in a different spot than in the last election. Does your firm take into political risk, and do you just diversify and hedge that through global investing, or what ways do you try to minimize those risks?
Well, two quick comments. If you pull up a chart of stocks for the past 120 years in the U.S. and overlay all the terrible geopolitical risks that had happened in the past century, no one would be an investor because you just like world wars, atomic bombs. You had a real pandemic that was even worse than this one 100 years ago. All these things one after
Mm-hmm.
another, and so you consistently have political risk. I mean, look around the rest of the world right now. Our friends in the UK going through Brexit.
Mm-hmm.
And then you can just go country by country and look at, I mean, some of the countries that we've invested in the past 10 years have essentially gone through their own Great Depressions. I mean, places like
Mm-hmm.
Brazil,
Yeah.
it's been really tough. Now, the counter argument to that is, our largest fund is actually a tail risk fund, which helps to hedge. It's like an insurance style fund where, people think in terms of insurance with their car insurance or house life insurance, et cetera. No one really thinks about it in terms of the stock market. And so having an allocation or portfolio that will benefit when things really hit the fan, like in March, can be that sort of sleep at night allocation to where it lets you survive with the rest of the portfolio. So trying to come up with that sort of balance,
Mm-hmm.
a lot of people have their portfolio, but they struggle with what you mentioned is that all of it tends to happen at once. Terrible economic recession, bad geopolitical event,
Mm-hmm.
portfolio goes down. And so having something that will diversify that, whether it's through options, whether it's through any number of investments, if that helps you sleep at night and get to the finish line, achieve your goals, whether it's paying for kids' college, retirement, going on vacations, whatever it may be,
Mm-hmm.
that's the most important. Because the problem that most people have is they sell emotionally when they
Mm-hmm.
don't want to. And we see it over and over again. We talk to people that sold in '09, never to invest again. Sold this
Mm-hmm.
year, totally out. And that's often the wrong way to approach it.
Mm-hmm. Definitely. And you talk about having a balanced portfolio, and I'm interested in your take on hedged assets, most specifically precious metals as well as Bitcoin. It seems like there's been a lot of institutional interest in Bitcoin, and it's done a very nice returns so far in 2020. Do you see those kind of assets as also a decent hedge to capital markets as well?
Yeah, let me mention one more too in this composite of three, because I don't want to sound like such a Debbie Downer about U.S. stocks are expensive, yada yada. The good news is most of the world stock markets
Mm-hmm.
are not expensive. They're either totally reasonable, all the way down to downright cheap, all the way to screaming cheap. So whereas the U.S. is in these low 30s PE,
Mm-hmm.
foreign developed, the most of the world is around 20, and then the emerging markets are in the low teens, and the cheapest bucket is at 10, and many countries are in single digits. So take your pick, 50% discount. We mentioned the UK,
Mm-hmm.
half the valuation of the US, and historically about the same returns. So
Mm-hmm.
US versus foreign assets is a coin flip. And if for most of your US investors put about 80% of their stock allocation in US stocks,
Mm-hmm.
when in reality, as a portion of market around the world, it's only about half. And the US is about percent of world GDP is about a quarter. The reason I
Mm-hmm.
bring this up, alluding to this next part, is there's this concept of what we call the global market portfolio. If you were to just go out and buy all the public assets in the world, what does that look like? Well,
Mm-hmm.
it's about half stocks, about half bonds, about half US, and about half ex-US. Okay. And that's a pretty good portfolio, by the way. That includes everything. Now, there's a few assets that are hard to include in that through public means. When I say
Mm-hmm.
public, I mean like mutual funds, stocks, ETFs.
Yep.
And one of those, for example, is single family homes. The other is farmland, which we talk a lot about. Most assets you can, gold you can easily invest in,
Mm-hmm.
as well as real estate. And Bitcoin is harder for most as well. So we always tell people that's the starting point. If you're a true index investor, John Bogle, one of the
Mm-hmm.
greats, that's the starting point. And I have no problem with people investing in a proportion of a market portfolio and then going from there. And so gold, I think it's traditionally played a great role in a portfolio. It's sort of like this weird cousin that sometimes does great and sometimes doesn't. It can spend years, decades going nowhere, right? It's
Mm-hmm.
hitting all-time highs, which, by the way, a lot of people get nervous about. We actually wrote a paper on my blog called "Is investing at all-time highs a great idea?" Is investing at all-time highs a good idea? No, it's a great idea. And we walk through investing in markets when they hit all-time highs. It's actually a good time to invest, which is where you're at gold now. So gold's a nice diversifier. Um, And then I put Bitcoin in the same category. We have been longtime sort of cheerleaders, not really involved. But if you were to look at the global market portfolio, 200 trillion, whatever it may be, crypto, still a small percentage. Let's call it 0.1%. So we often tell people like, look, you want to put some in crypto, Bitcoin, 0.1, or even you want to go crazy and put 1%. To me, that's totally reasonable, because if it does work out, that 1% goes to 10 or 20, in which case it's now a meaningful part of your portfolio. Or if it goes to 0, it doesn't really matter. It's not going to affect your long-term portfolio. But that applies to everything. That applies to all stocks, bonds, real assets. Problem most people have is they want to get way too much concentration. They want to bet it all on one. I'm a gold bug. I got 80% gold. I'm a U.S. stock guy. I'm a dividend guy. I'm a invest in Greek shipping companies, or I'm all in crypto. Often, more often than not, ends in tears.
Yeah, all eggs in one basket. It's not good when the basket gets crushed. That's great advice, Meb. And we're running out of time, but I would love to ask, the last question is, do you have any advice or suggestions or tips for people that are looking to stay ahead in the American economy, moving past the election into 2021, and how they can preserve their wealth?
I have a lot of opinions versus my sort of professional contemporaries that are a bit non-consensus. One of which is your asset allocation doesn't really matter that much. We wrote a book on this called Global Asset Allocation. It's free online. You can get it on Amazon probably for $3. We went through all these historical asset allocation portfolios back 50 plus years, and they all did well as long as you had some of the main ingredients: global stocks, global bonds, global real assets. The exact amount didn't matter. But the thing that did matter a lot is implementation. And this is boring. This causes people their eyes to roll back, to fall asleep. But fees you pay and taxes you pay have an unbelievably significant impact on your final outcome. And in many cases, people are still paying over 1% for mutual funds. They pay a financial advisor 1%, which may or may not be a great value. We love financial advisors in general, but usually their value is not on the investment side. And then taxes laid on top of that. And so the fun part is talking about what investment should we buy? Is it Amazon? Is it Apple? Is it Bitcoin? Is it gold? But in reality, a lot of people gloss over the part of the behavioral side and also the fees they pay. And putting that all together, I think, is a really thoughtful approach. And then second, which you alluded to, thinking about the future, this concept of trying to come up with ideas that are future proof, that applies to not just career, but also all parts of your portfolio, and thinking about jobs and where people stand. A great piece of advice I heard in the last year was Theo Epstein, baseball executive, was talking about how to approach moving up in your career. And he says, look, go to your boss, go to someone higher up in the organization, say, look, what's the 20% of your job that you hate that I can take over? And basically the concept is, how do you become useful to someone? How do you, big benefit is also you learn their job, but they become, not, I want to say indebted to you, but you took this 20% of their crappy job they don't want to do, offloaded it to you, but you're also learning their job. And so just so many people, as they grow up in their career and in the workforce, want to grow in terms of what's in it for them. But so much the concept of what's really going to push you forward is, how can you become totally useful to someone else? And that's a concept that's hard to learn. I had to learn it throughout my 20s many times over. But once you kind of come up with that idea, I think it's really beneficial in your career as well.
I really like that. And I think really the goal is to try and help others. So I think you're on the right path there, Meb. We're running out of time, but where can the viewers learn more about your show and the work that you're doing right now?
Yeah, not too many Mebs out there. We got the Meb Faber Show podcast. We have the blog of the same name, mebfaber.com. My day job is running Cambria, which is an asset manager. So you can go to Cambria Investments or Cambria Funds to learn about our funds. And of course, watch me pick fights on Twitter at Meb Faber. And again, if you find yourself in Manhattan Beach, come say hello too.
Sounds great, Meb. I will leave those links in the description box below. Thanks so much for the time, and all the best moving forward, and let's follow up in the near future.
It was a blast. Thanks.